Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of company reports before they can even finish their morning coffee. Today we are diving deep into Digital Realty Trust Incorporated's latest quarterly report, and folks, it is packed with numbers that tell a real story. So stick around because this is going to be good. Before we get into the nitty-gritty, let me be upfront. If you love breaking down these massive filings into easy, understandable insights, hit that subscribe button, and hey, we have a thriving Discord community too, linked down in the description. Come join the conversation. Alright, let us get straight to it. This is their quarterly report for the period ending September 2025. Think of it as their report card for the summer quarter. First up, assets. These are the things the company owns, and wow, their investments in properties net alone is over $26 billion. That is a massive amount of real estate, mostly data centers, mind you. This number has jumped up significantly since the end of last year from about $24 billion, so they are definitely investing heavily in their physical locations. Then there is goodwill, which is over $9 billion. Goodwill usually represents what a company paid for an acquisition above the fair value of the assets they bought. The fact that this number is so high suggests they have done some pretty significant buying in the past. Now, when we flip over to liabilities and equity, things get even more interesting. Total liabilities are just under $24 billion. A big chunk of that is unsecured senior notes, the company's debt amounting to over $15 billion. Unsecured senior notes are basically loans they took out that are not backed by specific company assets. The fact that they have so many senior notes over $15 billion is a big deal. This is money they borrowed that needs to be paid back with interest, and it is a significant chunk of their balance sheet. Now for equity, which is essentially what the owners have in the company after you subtract all the debts, their total stockholders' equity is over $23 billion, which has grown nicely from about $21.7 billion at the end of last year. This growth is a good sign, showing the company's value is increasing. Let us look at how the company made money and what it cost them. For the 3 months ending September 2025, their total operating revenues were about $1.57 billion. That is up from about $1.43 billion in 2024. So business is growing. The bulk of this revenue comes from rental and other services, which brought in over $1.5 billion for the quarter. This is their bread and butter, leasing out their data center space. Their operating income, which is what is left after accounting for the costs of running the business, was about $138 million for the quarter, a slight dip from $168 million in 2024. This might look concerning, but keep in mind it is normal for operating income to fluctuate quarter to quarter. Most importantly, their net income, the bottom line, was $63 million for the quarter. That is a good increase from $40 million compared to the same period last year. This shows that despite some fluctuations in operating income, they are becoming more profitable overall. And for us common folks, the net income available to common stockholders was about $57 million for the quarter. This is the profit left after paying preferred dividends, and it translates to basic earnings per S-share of $0.17. Not life-changing, but it is a step in the right direction. Looking at equity over time is always telling. For the 9 months ending September 2025, the company raised over $1 billion from issuing common stock. That is a huge amount of money from selling more shares, which they then likely use to fuel their growth and acquisitions. They are also recognizing about $26 million in amortization of deferred compensation. This is basically the cost spread out over time of share-based awards they have given to employees, something common in large corporations. It is also worth noting that the number of common shares outstanding has increased from 336 million at the end of last year to over 343 million now. This increase is a direct result of those stock issuances we just talked about, often used to raise capital. Now, let us get into some more detail on how they operate. This section clarifies that Digital Realty Trust Incorporated acts as the main entity, while Digital Realty Trust LP is the operating partnership, where the actual business happens. They are structured so that the parent company consolidates everything, meaning all the operations of the LP are reported as if they were one company. This is typical for REITs or real estate investment trusts, where the parent entity focuses on financial strategy and investor relations, while the operating partnership handles the physical assets. Their primary asset, investments in properties net, is reported at a hefty $26 billion. This number has notably increased since the previous year. This growth mainly stems from their strategy of developing new data centers and acquiring land for future projects. Goodwill, which sits at over $9 billion, indicates significant past acquisitions. The report mentions that changes in this figure are mainly due to currency exchange rates affecting operations outside the US. This highlights the global reach of their business. Their global revolving credit facilities net stands at over $1.1 billion, down from $1.6 billion at the end of last year. These facilities are like lines of credit that companies use for day-to-day operations or short-term needs. A decrease here could mean they are managing their short. term debt effectively, or perhaps using up some of that credit line for ongoing projects. The unsecured senior notes are a massive part of their debt at over $15 billion. This is a consistent strategy for them to fund their operations and expansions. Redeemable non-controlling interests are reported at over $1.5 billion. These represent stakes that third parties own in some of their consolidated entities, and these stakes can be redeemed by the third party or bought back by the company. This is a common feature in joint ventures and complex ownership structures. Stockholders' equity has seen a healthy increase, reaching over $23 billion. This is because they are generating profits and issuing new stock. As we saw earlier, this growing equity base is a sign of financial strength. The net income available to common stockholders shows about $57 million for the quarter. This metric is key for common shareholders, as it is what is truly left for them after all expenses. The basic earnings per S-share is 0.17. For the parent company, net income is over $67 million. This highlights the parent entity's profitability. Now, when we talk about expenses, rental property operating and maintenance is a big one, costing over $653 million for the quarter. This covers everything from power to physical upkeep of their massive data center portfolio. Interestingly, Digital Realty manages its business as a single global segment. They do not break down operations by region in terms of reporting segments, emphasizing a unified global strategy. However, they do provide geographic concentration data. Their revenue is pretty evenly split, with about 49% coming from outside the United States. Major concentrations are in Northern Virginia, Chicago, Frankfurt, London, and Dallas. This global spread helps diversify risk. Looking at property investment, the US holds about $10.2 billion, while international locations show a larger value at over $15.7 billion. This points to a significant international footprint and investment strategy outside the US. Their leasing activity is quite detailed. For expiring leases, they are seeing an average rental rate increase of about 4.5% for smaller deals, and a very impressive 27.5% increase for larger deals over 1 megawatt. This is fantastic news, as it shows they can charge more for their space when it renews. This is a strong indicator of demand. Overall, total operating revenues saw a healthy increase of 8.7% in the quarter. This growth comes from a mix of stabilized properties performing well and new developments coming online and getting leased up. Property level operating expenses increased by 8.2% in the quarter, which is a bit higher than revenue growth. Utilities are a big driver here, increasing by 5.5% year over year. They mention higher power pricing, which is no surprise given global inflation, but it is offset somewhat by rebates. The transactions and integration expenses have shot up. This is mainly due to fees for securing capital for their new US hyperscale data center fund and costs related to acquisitions. Remember that $3 billion fund they launched. These fees are a direct result of that. The gain on disposition of properties, net, is a huge number for the quarter, over $20 million, and over $952 million for the 9-month period. This is because they have been actively selling off assets or contributing them to joint ventures, like with Blackstone and that new fund they created. This is a smart strategy to unlock capital they can then reinvest. Interest expense has decreased by about $10 million for the quarter. This is good news, as it means their borrowing costs are going down, likely due to lower debt balances in some areas, even though they have been issuing new notes. Now, let us talk about FFO, or funds from operations. This is a key metric for REITs. Their FFO available to common stockholders is up to $570 million for the quarter, and on a per S-share basis, it is $1.65, an increase from $1.55 last year. This is a very positive trend, showing the company is generating more operating cash flow relative to its share count. So, what is the verdict on Digital Realty Trust's latest report? They are a giant in the data center space, and their financials reflect that. Their revenue is growing. And the fact that they are seeing such strong rental rate increases on renewals is super impressive. It means their properties are in high demand. They are also smart about managing their capital, selling off assets, and forming joint ventures to bring in cash for new projects and growth. However, they do have a lot of debt, over $18 billion. While they are managing it well with a lot of fixed rate debt and effective hedging, it is still a significant weight. Their strategy of forming funds like the new US hyperscale data center fund shows they are adapting to market conditions and bringing in outside capital, which is very strategic. Overall, Digital Realty Trust looks to be in a solid growing position. They are facing the same challenges as many companies with inflation affecting utility costs, but they seem to be navigating it well. Their focus on global markets and their ability to command higher rents on renewals are definite strengths. Alright, that is our deep dive into Digital Realty Trust's quarterly report. What do you think about their financial performance and their global strategy? Let me know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up and please subscribe for more insights like this. And as always, make sure to join our Discord community using the link in the description. Thanks for watching and we will see you in the next video.